episode, we're going to be looking at institutional sponsorship candle. So we're going to be looking at the likes of the fair value gap, which are actually the frameworks of our efficient and inefficient price delivery. We're going to be looking at the order blocks. We're going to look at the breaker blocks, mitigation blocks, and rejection blocks. Then in the coming episode, we're going to be looking at the advanced theorem to the formation of order blocks. So let's begin with the fair value gap candles. So what we can see here is actually a bullish example. We have the bullish candlesticks. So what really do we refer to as the fair value gap? It is actually when you're having series of 3 candlesticks, and you can see in this example, we have a bullish candlestick. So the high of the first candle and the low of the third candle. If the weak low of the third candle and the weak high of the first candle are not in contact to each other, they create this gap in the market. That is what we call the fair value gap. Because you can see this is the high of the first candlestick and this is the low of the third candlestick. So you can see that there is a distance between the weak low of the third candlestick and the weak high of the first candlestick in between the second candlestick. So this is what we call the fair value gap, what we call the imbalance, or we actually call the inefficient price delivery, meaning we do not have a balanced price delivery. Meaning in this example you're seeing here, we actually have buyers' energy and the absence of sellers. Because you can see this is an impulsive bullish candle, and then the second candle is also an impulsive bullish candle. And then you can see when the third bullish candle was formed, we don't have the presence of sellers pushing the market to actually mitigate the first bullish candle and the second candle to actually show us that sellers also tried pushing the markets to balance the markets. What we can see is an impulsive movement of price to the upside. So you can see how the weak low of the third candle and the weak high of the first candle did not contact each other. The third candle, sellers did not push the price to the downside to actually fill up this gap. So this is what we call the fair value gap, meaning we do not have the presence of sellers in this bullish condition. So therefore, it is an inefficient price delivery. It is not a balanced price delivery. Buyers are more heavily present than the sellers. So this example you're seeing here is actually an efficient price delivery, because what you can see, we do not have a fair value gap. So you can see that this is the first bullish candle, and then this is the second bullish candle, and we have the third bullish candle. And what you can see is the buyers pushed the markets to the upside, created the series of 3 candlesticks. Now you can see that in between the first candlestick and the third candlestick, you can see that price action actually returned to the downside to mitigate the high of this candle week. So you can see we do not have a gap. It is either price mitigates the high of the candlestick, that is the first candlestick, or the third candle week low actually return to mitigate the body of the first candlestick. So you can see here we have the presence of sellers, because you can see we have impulsive bullish move. But then in this particular candlestick, the third candlestick, the sellers actually push the market to the downside to actually balance the markets, to not leave any form of gaps in the price action, to not leave inefficiency, to not leave imbalance. And then now you can see that now we have the bullish candle to the upside. So you can see we do not have what's fair value gap, or we call imbalance, because you can see that the weak of the third candlestick actually mitigates the weak high of the first candlestick. So it is either you can see that the weak mitigates the weak high, or the third candlestick weak mitigates the body of the first candlestick, so that we do not have any inefficient price delivery. So this is actually an example of an efficient bullish price delivery. This is an example of an inefficient bullish price delivery. So let's actually check the bearish market condition. So this is actually the bearish market condition. And as you know that the bearish market condition is a downward movement price action. So what we can see here is that we have the first bearish candlestick, the second and the third candlestick, the bearish candlestick. Now what you can see to actually identify your fair value gap, meaning it is the low of the first bearish candlestick and then the high of the third bearish candlestick. So you can see from the low of the first bearish candlestick in between the second bearish candlestick and then the high of the third bearish candlestick, we have this fair value gap. So meaning we do not have the presence of buyers in this price delivery. So meaning this is an inefficient price delivery. It is not a balanced price delivery, because we have what? Impulsive bearish movement to the downside. sellers did not actually allow the buyers to push the market to the upside to fill up this bearish candle and mitigate the first bearish candle week low or the candle body low of the bearish candle. What we can see, we just have what? The impulsive bearish movement of price to the downside, leaving this imbalance in the markets. So for the efficient price delivery, what you're going to see is that we have this series of bearish candlesticks to the downside. You can see that the week low of the first bearish candle and then the week high of the third bearish candle actually mitigates each other. You can see we do not have a gap in the markets here. So we do not have what's the fair value gap. We do not have imbalance. So this is actually an efficient price delivery. So now you can see that the buyers pushed the price to the upside and then mitigated the week low of the first bearish candlestick. So you can see now we have what? An efficient price delivery in this particular market condition. So what you must understand is that when the market actually leaves fair value gap, the market will actually return to fill up that fair value gap. So this is a very important fact you must understand. So it is either price return to fill up the fair value gap completely, or price will return to the midpoint of the fair value gap to fill it up. So when we check chart examples, you get to understand. So now what we can see here in the chart is we have this bearish market condition. And so you can see that now price gave us this impulsive move to the downside. Price took out this low point. You can see price created this fair value gap from this candle week low and then this candle week high. Now you can see how now price took out sell side liquidity, broke the structure. Price returned to fill up the fair value gap. Price returned to actually give us an efficient price delivery. Because what we can see here is we have the massive presence of sellers in the markets. Now buyers actually return to rebalance the markets before we have the bearish continuation. So you can see in the market, what you're going to see is that the market will return to fill what's the imbalances, the fair value gaps. So you want to look out for these fair value gaps within your premium or discount price level, depending on the market condition. In this particular episode, I just want you guys to understand how to identify the fair value gap. We're going to come to the application of this sponsorship candles. So now what you can see now, price return and then fill up the fair value gap. Now you can see we have this price action within this range or this high to this low. Now what you can see is price return to the downside, went back up to fill up this fair value gaps price created within this leg. Now price dropped to the downside to cut this low point. Now you can see price left this fair value gap. You can see how price returned to completely fill up this fair value gap and then price fell to the downside. So I told us guys in the institutional market structure video to identify ideal institutional market structure. I told us that the market actually moved to fulfill 3 things: fill up inefficiency, take out internal range liquidity, and also the external range liquidity. So now what we can see is that now price took out this low, took out this external range liquidity. Now what you can see is that now price return to fill up the what? Fair value gaps, to fill up the imbalance in the market. So I told us that at times you would see that price would not completely fill up the fair value gap. And this is an example of that. What you can see is that we have the return of price. Price completely filled up this fair value gap, completely filled up this fair value gap, price return. And then you can see price return to a premium price level. So I can see how price returned to this fair value gap and then dropped to the downside. Now you can see that price did not completely fill up this fair value gap, but yet price mitigated the fair value. And then you see we have what? The fall of price to the downside. So you can see how price created fair value gaps also here. Now you can see how price returned also to fill up this fair value gap. You can see it returned again to this previous fair value gap, yet also did not completely fill it up. Price again fell to the downside to fill up this fair value gaps. So now you would see what? Imbalance price delivery in the charts. Price in the future will actually return to rebalance its price delivery. So now let's look at this example. This is a bullish condition. Now we can see how price took out this sell side liquidity. I told us how to identify ideal institutional market structure. You can go back to the 10th episode and also the 8th episode to actually look into that. Now you can see how price took out this sell side liquidity and then price pushed to the upside, and then we have break of structure. So you see this is a valid high point because it took out sell side liquidity, and then this is a valid low point because it took out the external range liquidity. So you can see that price actually gave us this fair value gap at the zone where price took out the external range liquidity. So you want to look out for fair value gaps that leads to a break in market structure. Yes, you want to look out for those kind of a fair value gaps, and which are also within your premium and discount price level, depending on the market condition. Now we can see we have the impulsive move that's got external range liquidity. Now we have our inducements, expecting to see that price will pull back and take out the inducements before we have continuation to the upside. So we can see price broke structure return. This is a valid pullback because took out this candle's low point. So we have our first inducement, but then we have a transfer to this low point. So price pullback, and then we have this impulsive move. This is not our inducement. This is a minor inducement. This is our major. Now you can see how price left this fair value gap. Price return, filled up the fair value gap. Price again pushed to the upside to fill up this fair value gap price left. You can see there we have the drop of price. Now you can see that price filled up this fair value gap. Price again returned to the downside to fill up this fair value gap. And now you know that we have our inducement, expecting to see the price rate the inducement. So definitely below the inducement, what do we have? We have this fair value gap. Now you can see how price returned, mitigated the fair value gap. And this fair value gap is within the broken price swing points. And it is below the swing point itself. Now you can see how price returned to the downside, mitigated the fair value gap, and then we have the push of price to the upside. This is our inducement. This is our internal range liquidity. Price took out the external. We want to see price return to take out the internal range liquidity and fill up any form of inefficiency. And then we have the push of price to the upside. And you can see the price completely filled up this fair value gap. And slightly below also is another fair value gap. So you can see how price now even broke through this other fair value gap just to mitigate a portion of the fair value gap below this other fair value gap. And now you can see how we have the push of price to the upside. So again, let's look at this other example. I really want you guys to understand the concept behind this fair value gaps. So now you can see we have the push of price to the upside, price return to the downside, broke structure. Now what you can see is we want to identify our inducements. So we have the break of structure. This is the first pullback, and then price continued the movement. So this is our inducement. Price took out external range liquidity. So we want to see the return of price to take out what? Internal range liquidity. So above the internal range liquidity, we want to be identifying fair value gaps or other blocks. But for this particular episode, I'm stressing more on the fair value gaps. We'll get to the other blocks here. So now you can see this is our inducement. Price took out external range liquidity. So above the inducement, what do we have? We have this fair value. So you can see how price is return to mitigate the fair value gap, and then we have the fall of price to the downside. You can see price created this fair value gap, price return, fill up this fair value gap, price again return to fill up this fair value gap. Price now projected to actually mitigate the ideal fair value gap above the inducement swing high points. Now we can see the impulsive move of price to the downside, and then price what? Broke structure. So we have our high, we have our what? Low points. And now this is the inducement price created before the break of the swing view. Price again gave this pullback. So we have the transfer of inducement from this swing high to this other swing high point. So this becomes our engineered liquidity. And above the engineered liquidity, we have this fair value gap and this rejection block. So we're going to treat the rejection blocks in this episode. But then I want us to basically pay more attention to the fair value gaps. So you can see that this candle took out what? This buy side liquidity, and then we have the price created the inducement and the engineered liquidity. You can see fair value gaps. So now we can see how price return. Price filled up the fair value gap. Yeah, price filled up this fair value gaps. But then we can see that this is actually the ideal fair value gap we should look out for, because this is where we have the rejection block. Price took out this buy side liquidity and then fell to the downside. Now you can see how price return. Price mitigated the fair value gap, and then price fell to the downside. Now we can see that price did not completely fall to the downside to actually take out this external range liquidity. Now this is the reason also behind this. Now if you're taking your entry from this fair value gap and your stop loss slightly above this rejection block high, you can see that even if this return to the upside, this will not take you out. So So you can see now price actually continued the movement again to the upside to completely fill up this fair value gap. Because you can see that this rejection block did not completely fill up the fair value gap. And then slightly above the fair value gap, we have the unmitigated order. So that is why you can see the price return further to the upside to actually mitigate the order block and completely fill up the fair value gap. And now we have the fall of price to the downside. So you must understand that the market will create fair value gaps and then rebalance those fair value gaps. We're going to have inefficient price delivery, and then price would return to actually give us an efficient price delivery. So this is how you identify the fair value gaps.